Welcome to TheoTrade. This is Don Kaufman doing the weekend update here on March 18th, 2017. First and foremost, the S&Ps this past week, the week of the FOMC announcement, rates were raised. I have to tell you, we were anticipating some volatility this week. We didn't really get it. What a disappointing week in terms of volatility. So we're going to do a brief overview of some of the action in this previous week's trade. Of course, the raise of rates over there, nothing too unexpected. And then more importantly, we're going to give some forward-looking kind of statements here. I'm also going to give you some big picture ideas. One of the major issues I think that faces us in today's market. So let me start with the SPX specifically today. You know, looking back at this week, I think a lot of traders and so forth, they're like, oh yeah, it was a big rally this week. And okay, so we rallied after Janet Yellen comes out, speaks, you know, she sees her own shadow. She'll be back in 6 weeks. That's right. We do compare Janet Yellen to Punxsutawney Phil here. I know we're about a month past Groundhog's Day, but nevertheless, it's the FOMC. It is Groundhog's Day. With that, in the SPX, so I saw a lot of traders discussing the rally all week, and I always like to go, time out. Have you know, what are you looking at a chart over here? You see the market explode up on Wednesday. Let's get to precise details. When I say precise details, the first thing I'm going to do is I'm going to go over here to the analytics on thinkorswim and just want to make a quick point with this, with what has the market done. So the market ultimately, and this is March 17th, all right, trading day. So again, we're looking March 17th now. We just backed it up a day over there. St. Patty's Day, the last trade was 23.78. Great. What were we the prior week? So we closed the week at 23.78, an expiration week, a triple witching expiration week. Just back up to last week. Oh yeah, we were at 23.72. But still my heart. We rallied what? Less than 6 points on the week. The point, though, that's to be made over here is that the markets this week were anticipating as much as, $27 move. What did we get? $6. We have a $6 move all week long. So there goes your idea of a big rally. And by the way, I just backed up 1 week. Check this out. I'm going to go back up to March 5th over there. Go to March 5th. Well, we were at 23.83. What has the market done for me lately? Absolutely nothing. However, the volatility, of course, was a little bit bigger last week. Now, I'm going to cut to the chase right now. Now I'm going over to live volatility. So I'm no longer in, what we call think back here, which is just end of day data. Again, I'm cutting over to the live area of the platform. And, people ask, well, what can we expect this next week? All right. So this coming week, forget, I know we get really infatuated with looking at a calendar. So we can cruise over to the calendar, and you can push the date forward on the calendar, and you can look at different weeks out there. Oh, here's all the different announcements coming out. But frankly speaking, this is not the place that I start. It doesn't matter what announcements per se are coming out. Yeah, okay, there's durable goods coming out. I get it. But what matters is how the market interprets that risk. And to show you a little bit and to differentiate, the entire week, this coming week, is only expecting a $25 move, which means that the volatility is actually contracted pretty considerably from the previous week. Again, we were really disappointed last week. It's one of the first times in a while we've seen volatility kind of pick up. Well, guess what? This coming week, they're showing volatility very, very low out there. All right, so just keep that in mind. Does this mean with low volatility, what does it mean for you? First and foremost, last week, I was not really wanting to buy any straddles or strangles. And I've been doing this strategy where I'm going out there and doing what I call a buy and bail. And that is on a day-to-day basis, I'll use either the Monday expiration, okay? And I'm just going to tighten up the number of strikes. I use the Monday expiration, the Wednesday expiration, or the Friday expiration. I'll literally buy a straddle or strangle, let the market move and bail out of it. And I'll do it again and again and again throughout the course of the week. Last week, I didn't want to because the volatility was pumped up versus the 6 previous weeks. However, this coming week, it's one of the things that I'm going to keep in mind. So that's kind of how I set up my week a little bit. I know a lot of people are like, well, let's do some homework on the charts over here. And, you pull out your Fibonacci's. Okay, there's no feel for markets right now. None. And I don't mind telling you that, other than, I am seeing some expansive ranges, but it was news driven. It was catalyst driven, from the FOMC. All right, great. But again, there's some decent ranges that we're getting on the trading day. And that's why I like the idea of buying or bailing out of these straddles and strangles. Although we're seeing some increased ranges on some intraday basis, when that just basically means we're getting bigger point moves a bit last week. That's just opportunity on an intraday basis to, again, buy some premium and then bail out of it after we've made a couple of bucks on it. Nothing more, nothing less. Now, let me kind of close this up, because throughout the course of the week, again, frankly, the volatility doesn't really lie. It's not showing a whole lot of anything. I mean, what? Oh, look at that. We're at a 9.6% volatility over there and a $25 expected move. Now, this can change. Because volatility is still inherently low, though, I'm not going to be selling premium. It doesn't matter. Well, we stayed inside the expected range. If you sell premium right now, you're just playing chicken with the market. In the market, it's always going to win. So what we're going to have is 6-7 weeks of no movement, no movement, no movement. All right. And then it's going to be followed by this burst. Okay. In my interpretation, we're probably going to burst up and then ultimately down. I wear my position right there on my shoulder. I'm absolutely bearish in the market. That doesn't mean I'm bearish like tomorrow. Okay. Overall bearish in the market. But again, never hide the position over there. But again, we could be flat for 6 weeks in a row, and you could sell premium 6 weeks in a row. On the 7th week, we're going to have a 3 standard deviation move. That's all the market has been doing lately, is torturing us with these 3 standard deviation moves and keeping premium sellers at bay, which is a good thing. I've been buying premium lately. And again, I created most of my career on being a premium seller. I don't mind saying that. Now, as I was saying, just being forward looking over here, that's the S&P. But throughout the course of this past week, I've been talking a lot about the bonds, and I think I really struck a nerve with a lot of people. So I'm going to discuss bonds a little bit here on this weekend update, and I'm going to show you some interesting kind of facets of the bonds, because this I believe to be one of the most important areas of the marketplace. And again, this is when I'm going to give some forward-looking statements. This is not forward-looking like next week. This is much more longer duration kind of stuff. But I want to show you one of what I feel is the largest issues that face us and why we have, and are anticipating so much risk in the S&P 500. I'm going to display that to you in the bonds. By the way, one other interesting thing before I go head on into the bonds, I don't want you to miss this, but for those of you that do understand skew, here, I'll actually bring it up for you real quick, and then I'm going to dive into the bonds, because we're talking a little bit about risk over here. It's okay. We could deviate for a moment. But one interesting thing, for those of you that understand skew threw off its highest reading in the history of the product. Actually started back in 2014, threw off the highest reading of skew. That is the out of the money puts in the SPX. The out of the money puts in the SPX, are trading right now for a higher implied volatility versus the out of the money calls than ever before recorded. And if you want to look at that, instead of looking at the actual skew, you can look at the SPX, open up options that are about 30 days out. You can actually open up the 33-day expiration. Open up a bunch of strikes in here. We go, some 40 strikes. Flip open to implied volatility. And what that skew measures is, when I say these out of the money puts, look at the out of the money puts over here. They're trading for like a 12.6 vol, right? And if you scroll down, the out of the money calls, these things are cruising around like, barely 7%. So the differential from call to put is massive. But the skew, it measures tons of just way out of the money options. Anything that's like 0 bid or 5 cents, it doesn't really measure. But as you start coming out here, look at these out of the money options in the puts. They're trading for like, 33, 34%, 28%. Then you scroll to the out of the money calls, And these things are trading for like 7%. Okay, the largest skew ever recorded out there. Now, let's get back to the bonds. Back to the bonds. So throughout the course of this week, and this, again, it struck a nerve with a lot of our clientele here at TheoTrade, I brought up the TLT, and it was simply making a point on the TLT. Okay, why do bonds matter right now more than really ever before? Number one, okay, the bonds, they have a rather high implied volatility. Now, if you've never tracked bonds over time, bonds historically have been like, it's a very mellow product. Nobody has to worry inside of a bond product. That could not be further from the truth, okay? Go look at the TLT, and I'm using the TLT instead, like the bond futures, okay? These products, the ZB and the ZN, that confuse some people, so I'm not going to talk about those right now. I'll use the TLT, suffice to say, as the bonds. Look at the implied volatility, and this is equivalent to like a 20-year. It's about 11%. Now, time out, just compare that to the SPX. The SPX, all right? It's sitting about 10, 11. No, it's all the way out to like 11% out here. The point that I'm making right off the bat is that the bond volatility, okay, is either the same or even higher in most cases than the S&Ps. Okay, so all right, Don, the bonds have more volatility. You got that. Okay. Well, why do the bonds matter more? Well, because the bonds right now are in motion. We've had this fairly extraordinary sell-off in the bonds, and this could be only the beginning. However, let me make something clear. I'm actually more bullish on bonds, but my directional bias here, I don't want it to play a role in this conversation. My own directional bias, leave it out. Nothing more than an opinion. You know what? You want an opinion, oh, turn on CNBC, turn on whatever, okay? I'll give opinions where needed, but that's not my argument inside of the bonds. The big issue in the bonds right now is, number one, they're displaying quite a lot of volatility. Okay, you got that, all right? When the bonds, though, start to get volatile, the implications back to the S&P 500 can be quite dire. We don't really know of some of the implications, and why don't we know? All right, so now I'm going to give you a little history on the bonds, and I think that this is really going to resonate. And you're like, bonds, first of all, and I'm going to say this again and again throughout the course of this, they matter more now than really at any point that I can think back historically, all right? And I even talked to other traders about this, and they're like, yeah, I kind of agree. I mean, the bonds are at the largest inflection point, I believe, that they've ever been inside of any recent history. I mean, I'm sure people can make arguments back into the 1970s, or even the early 80s when interest rates in the short duration were up to 16, 17%. But right now, bonds are at a crossroads. And this is the real reason why. So let me actually just open up a TLT chart. I'm going to show you something quite entertaining. This is just a 9-month TLT chart. Forget right now that the bonds have sold off, okay? But usually when products sell off this hard, right? And they have. I mean, you're like, oh, from 143 to 116, that's not that bad. Yes, but this is the bond market. It's huge, people, in terms of percentage moves. Now, the interesting thing is, you don't see like a huge spike up in volume so much in here, maybe a little bit back here, but that's the election. Now we're going to open up a 20-year weekly. Now, why don't I open up 20 years inside of the bond product? I opened up 20 years inside of the bond product to make a point, not so much about the bonds themselves. I want to make a point about bond and bond volume. So take a look at the bond volume, which right back here, this was the financial crisis. Everybody remember that? Why is the bond volume all of a sudden right here so ridiculously large? Okay, what changed in why all of a sudden in 2010? Now, yes, the Fed got involved. All right, the Fed did some bond buying themselves out there. Okay, but a huge amount of that started back here. The big time quantitative easing, no doubt, started in this neighborhood. But if you notice, bond volume is it's exploded in recent years. This has a lot to do with the Dodd-Frank bill. And I told you, we're at a huge crossroads in bonds, and some of this has to do with regulation. It has to do with the Dodd-Frank bill, okay? So back after the financial crisis in 08-09, they actually instituted some, restrictive trading practices upon most of the major too big to fail firms. And part of that was Dodd-Frank, specifically the Volcker rule, and it eliminated a lot of proprietary trading. So what that basically means is firms like Bank of America, okay, your JP Morgans, all these really big market making firms, Bank of America, okay, JP Morgan, Goldman Sachs, they often are market making firms, and they're also very, very large participants in the markets, okay? But what that rule states in there, and most of the banks are adhering to the rule right now, even though it hasn't been like officially enforced in some cases. Most banks are adhering to this rule. And what the rule ultimately says, it says you can't take proprietary positions, for instance, in the S&P 500. You can't take proprietary positions inside of the S&P 500. You're like, what does that mean? It means they're trading net neutral. They're not trading a lot of directionally biased strategies, okay? And so they can't take a lot of direction in the S&P. Like they can't take a big directional position, for example, in Apple. They can't take a huge directional position in Google. They can make markets in here, but they can't take big directional positions. However, you have to remember right here, right now, okay, Dodd-Frank and portions of it might be repealed. Oh, well, you know what, though? That's all conjecture at this point. We don't know exactly what areas are going to be repealed of it. All we know, okay, is that when the Dodd-Frank bill came in, okay, and it eliminated a lot of proprietary trading, the area that it did not eliminate proprietary trading is inside the bond market. So what's my argument in here? Well, it's a really simple one. The banks and so forth can't take huge risk inside of the S&P 500. They can't take huge risk, for instance, in Apple, but they can take extraordinary risks and are doing so inside of the bond product. Why do you think that during the financial crisis, okay, the financial crisis was about the bond market? That's what, I mean, it was a huge, it was mortgage-backed securities. Yeah, okay, it all relates back to the treasuries though, right? Interest rates. And yet the volume over here was nothing in comparison to right now. So I want you to think about that the bonds, okay, you've seen them move a little bit. You realize how catastrophic these movements can get in this kind of volume. The other reasoning I'm going to show you over here of why the bond market is so incredibly important, and that the bond market, okay, this really, to me, holds the keys to the next massive moves inside of the S&P 500. I'm going to show you something interesting that's going to shock you. So if you take a look, again, at bond volume, it's extreme. All right, pretty much right now, you're like, the markets are totally docile, Don, and why are you showing the bonds over here? Because the volume right now is just picking up inside of the bond market year after year after year. You can see it's because all the banks are in there. But I want you to compare that to equity products. All right, if this is true, like they can't trade heavily in the equities, go look at Microsoft. So what we're looking at right now is a 20-year, all right? It's a 20-year weekly. Why am I looking at a 20-year chart? Just to show you the current trend. Okay, look at Microsoft. All right, so volume is pretty big. Oh, back over here in 08, it got really big and it just kind of peters off. You know, that's because nobody's actually trading any more Microsoft, except that they're buying back their own shares over there and some arbitrage going on. But nobody cares about this individual equity product anymore. Let's go on. Let's show you another one. Spiders. Okay, let me bring up the spiders, which is, you know, like the granddaddy of all the products out there. Now, the spiders are traded by all the different firms. You can see, obviously, big spike of volume. Everything kind of pretty much peters off right now. Bring up another one over here. All right, let's go around to different sectors, because, again, the point needs to be made that there's really not a lot of firms involved, all right, in markets. They're just making markets out there. Look at something like ExxonMobil. Okay, pretty good. Again, volume kind of petering off, except that you see monstrous volume inside of the bond products still, but in all the equity products, it's just dying out. So anyway, that's ExxonMobil. Wait, we're going to have fun. Intel. Why am I going to bring up Intel? It just even had an announcement lately. All right, they just had a huge announcement. They're buying Mobileye, yada, yada. Okay, volumes have done nothing but actually drop inside of there. Wait, there's more. Okay, what's heavily influenced by interest rates? Bank of America. You would expect Bank of America's volume, obviously, in 08, 09 was huge. also drops off. No matter what you want to look at, you can even look at ETF products like XHB, the home builders, some of the lowest volume we've seen lately. Okay, this is a very, very scary proposition. All I'm getting into is the fact that volumes are completely dead in the equity products. Okay, they're dead, even in the ETF products. And, people are obviously going to argue that, to the death over there. But here, you want to see Apple? Apple, it's got some of the lowest volume that it's seen, all right? In what? You're looking at 20 years of Apple. There you go, 20 years of Apple. Apple's volume, okay, was bigger during ultimately the bubble back in 99 and 2000 over here than it is right now. Nobody is involved right now in equity products, okay? There's no sustainability out there if equity products were to start to turn around. You have got, all right, to let this sink in. That and all the banks right now, they don't care about the equity products, right? All they care about right now is the bonds. That's where they're at. And the bond volume continues to kind of pick up out there. So, you're like, well, so where are you going with this? When the volatility strikes the marketplace, okay, first of all, you know that the volumes are really, really light in the equities, okay? When the volatility strikes, it is going to be amplified tremendously because of the light volume in the equity products, because these firms are into proprietary trading, because the firms are not taking big directional risk. It's going to cause them, all right, to ultimately sell into selling like you have never seen before. But the bigger issue in play right here, it's not just the light volume in the equity products. It's the large volume inside of the bond products, okay? Why? Because if Dodd-Frank is repealed, or a portion of Dodd-Frank is repealed in the very near future, it could unleash the beast of traders from the proprietary trading world back into the equity market. Do not for a second look at that as being bullish. It would be the return of extreme volatility. All the signs, all right, are still pointing to the idea that the S&Ps are going to see extreme levels of volatility. Again, the one thing that really stuck with me is when you look at something like Apple and you're like, whoa, that's pretty scary. Apple's at an all-time high. Yeah, and there's absolutely no volume. Over 20 years, the volume has not been lower in many of the equity products that you trade over there. You're like, what's substantiating the up move? Stock buybacks. Just stock buybacks. And with all those stock buybacks, you have to realize, what is the FOMC saying? They're saying we are in a rising interest rate environment. How long do you think stock buybacks last in a rising interest rate environment? Not long. That's what I want you guys to think about here on this kind of a weekend update here at TheoTrade. Join me throughout the course of this coming week in the TheoTrade chat room. Thanks, everybody. This is Don Kaufman. Have a great weekend. Bye-bye.